Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter, see what people are talking about like we normally do. We're going to be talking about topics that are wealth building, financial topics, and a lot of commodity type stuff because that's what I'm interested in. That's what I think everyone should be interested in at this time, as that's where the value is in the markets. So let's dive in here and I'll give you my financial opinions. Again, if you want to follow me at finding_finance, and if you want to join our community, finding-value.com, that's where I go into the individual companies, why I like them, why I think they're so great, and how I am positioning in the companies and how I'm weighting certain things. So we've got T-Bird. All right, who slipped CCJ the Viagra? We've got a monster move to the upside, breaking on out. We've got the bullish engulfing the day before, and then the big continuation pattern move. This could turn into a big move to the upside and a breakout. A breakout is when you've got technical resistance that you're fighting. Generally, it's a trend line that you keep hitting and hitting and hitting. And then eventually, when you break through that trend line, it's like a burst of force breaking through the door, basically running into the wild. I call it's a cheetah. Cheetah running in the wild. It breaks that resistance or breaks that area and just starts to run with cheetah speed. It's real fast. Boom, boom, boom. It accelerates to the upside. A lot of the uranium stocks are exhibiting very good patterns that they are breaking to the upside. CCJ is one, but the Sprott Physical Uranium Trust, the ETFs, and a lot of the individual companies are all breaking their patterns. If you try to participate in these things, it's going to feel like you're going to chase the movements, or you buy the pattern and then the movement comes after the pattern is broken. So that is what I think occurred. We had a chart technical pattern. We've broken the pattern and now it's starting to run to the upside. It says a wall of institutional money is coming to energy. A fraction of it will propel uranium to the stratosphere and beyond. Now, I know people are getting very excited about this move. You should already be positioned and waiting for it to transpire. You shouldn't be running around chasing things. Now, there are certain things that you can do as an investor. We're starting to see CCJ break to the upside and URNM and some of these larger ETFs. You can look at some of the lagging companies that are still in the sector that possess very good patterns that haven't really broken out yet. That is probably what I would do if I was a uranium investor. I would be looking at the lagging companies, those that possess what I think are good patterns, haven't necessarily run very much, and you can still add to some of the laggards. 500K is not halfway to 1 million in investing. Few understand this. So people, when they look at investing, they look at things from a linear perspective, not from an exponential geometric viewpoint. So 500K is not halfway to 1 million. The reason is because of compounding and the geometric function to it. So when things compound, they don't go up linearly. And 500K to 1 million is a linear thought process. It's not the way that it works. It's going to feel like the beginning of investing takes forever, and then things will speed up dramatically towards the end when your account value hits a certain size. Compounding really kicks in. It really does well if you know what you're doing in the markets and you position in very undervalued assets and you compound that money at far greater returns. That is where you want to really get good at. How do you compound the money at greater returns? That is the question everyone should be asking. So one is things don't move linear, and two, it's very important to compound things in a way. And you don't have to compound everything at max, putting things into very risky investments. You can do a combination where you're finding the best risk reward in the markets. And that's where being a seasoned investor versus a newbie, you balance everything out based off risk reward and probabilities. Scrolling down, what did you study in school and are you using it today? I studied engineering, which is manufacturing engineering, and I did a lot of math, physics, science type stuff. Yes, I'm still using it, and yes, it has changed my thought process forever. I will say that. People who say money doesn't buy happiness already have it. Um, I would say it's almost the opposite. A lot of people, it's like the fringe. It's either people who don't have it or the people who do have it may say that. I've heard from a lot of people when I was growing up in my 20s, people at work, they'd be like, what are you going to do? Die with a bunch of money? Because I kept saving all my money when I was in my early 20s. Like, you're going to die with all your money? I was like, I hope to live longer than 25 years old. So I'm not going to spend all my money right when I get it. So a lot of people that told me that were people who don't have a lot of money. They were a lot of people who came from other countries that are not very well off, and I don't know, it kind of bothered me to some extent a little bit, but I don't have that mindset. I don't think money will necessarily buy you happiness, but I think to some degree it can if you configure your life a way around money allowing you freedom. And freedom can, for some people, be happiness. I think a lot of people who they try to buy happiness, that's probably true for buying it, but it allows you to free yourself from, I'll just call it frees you from basically slavery. It's not the technical term of slavery, but it's like the emotional and psychological form of slavery of having to have a job. And for some people that's freedom, and it's like, I don't know, it's not really buying happiness, but it's getting away from slavery. I have 100K invested at 24 years old and still feel poor. They were right. 100K really is a loser's number. I'm gonna say something here, guys, and obviously my opinion, but don't have a mindset that's like that. And what mindset am I referring to? Do not, in my opinion, if you want to be a successful investor, do not have a negative mindset. This is a negative mindset. This is just, I don't know. I don't like that mindset. So you can have any amount of money. And you know what always mindset I had, even at 24 and 25 and 26? My mindset was like when I went to go work out, it was, I'm going to be a multi-millionaire. I don't really care if it takes me longer than some other people. I don't really care what it is. I'm just going to continue to stack money through investments. Now, these guys look at this. This guy's 24 years old and he has 100,000 invested. He's doing pretty dang good. And feeling poor is a state of mind. It's not a reality per se. Is 100K rich? No, 100K invested is not rich. But if you have 100K and you put it to work and you understand the principles and have a vision of where you could go, I think you could turn 100 grand into a lot of money. A lot. 100K is a pretty good chunk of money already. So I think this is I'm going to say it, a loser's mindset, a loser's mentality. Oh, I've got 100K at 24. It's losers, it's really a loser's number. That's just stupid, guys. I'm sorry. I do not like that mindset. You have 100 grand and you invested it. You're doing very well. Stick with it. Do not listen to other people. Keep stacking away every day. Boom, boom. Just keep inching forward. I don't care if some years you save tons of money and other years you save little money. There's a couple of things that you can do to vastly improve one's situation. Save money, learn how to invest, keep improving, keep refining. That is everything. It's everything in life. Everything in life is get better, get smarter, do whatever you need to do, keep progressing towards the thing that you want to be. So I don't think being rich is the end goal for some people. For me, it's more of financial freedom. It's the freedom to do whatever I want. It's the freedom to turn down a crappy job. It's the freedom to sleep in when you're tired. It's the freedom to buy a steak instead of, we'll call it high fat, kind of garbage beef, let's say. Like, it gives you the freedom to do some certain things. And I think that is what I value, at least. And I just don't like that mindset. I don't know why. It's still making me mad, but I don't like that mindset. I don't like loser's number. It's not a loser's number. It's every single millionaire, every single billionaire passed through 100K on their journey. Every single one. So you can't say it's not a lot of money. It is a lot of money, and it's the necessary path to get where you want to go. Everyone crosses 100K. Everyone. Some people cross it early. Some people cross it later. Some people cross it later and they compound it like no other and turn it into a lot of money. And they do whatever the heck they want to do with it. It says, we're in what will likely become the worst secular bond bear market in U.S. history. The bear market in the 1970s ended with 10-year treasury yields above 13% and 30-year yields above 15%. With today's 16-year high yields of 4.35 and 4.46, yields still have a long way to rise. They potentially do, and they've been very strong. We have not seen an accompanying sell-off in the overall stock market, the S&P and the NASDAQ, that reflects the yields that are being shown today. I think the markets are confused. They are confused because the S&P 500 is pricing lower interest rates, but the bond market continues to increase interest rates with a bond market sell-off. So which one is right? I don't know. I mean, it's tough to say which one is in the correct stance. If I were to guess, I'm going to side with the bond market, and I think the bond market and the yields are going to push the S&P and NASDAQ lower, is my guess. But that's where I'm going to side. Global onshore crude inventory data is so bullish that it's making people do a double take. The same double take I did when I saw how much Saudi and Russia decreased crude exports this month. We will know soon enough. So, guys, inventory is about to get slaughtered in oil. And if you look at global onshore crude inventory data, it's bullish. And even that's floating inventory is very bullish for prices to go higher. Doesn't mean that it will necessarily just go straight up. We're going to get our movements. We're going to get our pullbacks. It's going to be an upward move for oil and I think energy in general. Housing inventory alert. There are 496,000 single-family homes on the market, the highest all year. Let's take a look. So this is where we're at right now. It's a little bit higher than the beginning of January for available inventory. But, we are still at very low levels for inventory for the housing market. 496,541 is still far below all of these years where the housing prices still increased in terms of home prices. There are 365,000 single-family homes in contract now, 10% fewer than last year. Only 63,000 new contracts this week. I've been hoping for sales rate to pick up, but there's just no sign of it. Now with mortgages over 7%, the pace of new contracts is slowing again. What a lot of people thought were that interest rates or mortgage rates going up were going to completely destroy the housing market. The fact is, they haven't. We are still at very low inventory levels. Home sellers are reacting to slightly fewer buyers too. Price reductions ticked up to 35.5% of the market this week. It looks like soon we'll have more price cuts again than 2018 or 19. These are subtle moves, slightly fewer buyers, unlike last fall, but worth noting. So we do have some price reductions, and they are mimicking some years before. Home prices are holding on their summer plateau better than last year. The median price of a single-family home is about $450,000, unchanged from last week, and just a smidge higher than 2022. The price of the newly minted contracts this week is $378,000, just a hair above last week and last year. The new sales price had been nicely above 2022 for several months. Now those gains are mostly gone, at least until September. 2023 home prices will be up 0 to 3% versus 2022. So that's some information on the real estate market. I know I haven't gone over real estate market recently, but there's some new information. 91% of U.S. mortgage borrowers have mortgage rates below 5%. So the majority have below 5%. 91% do. Eric Nuttall, much like my kids on one of our summer road trips, energy investors have been asking, are we there yet? Are we there yet? Are we there yet? With oil and water imploding, a precursor for what we will soon see in more visible onshore levels after a very long ride, we've arrived. So what this is telling us is this is the oil that's coming over water that will eventually make it to our inventories or the lack thereof. As you can see, we had a lot of oil on the water in 2022, and you can see we've got a dramatic decline that hasn't hit our onshore inventories yet. And that's where everyone's doing the double take. They're looking at oil on the water saying, man, this is going to be ridiculous when this hits onshore inventories, when the numbers come out of those deficits or drawdowns, I should say. Here's Grady. He says the ratio chart has a smaller red positive divergence once again at extreme lows. Just before the two previous huge moves back in 2016 and 2020, I do like high potential solid setups where it is only a question of when, not if. So what he's charting here is SILJ versus SLV. There's been a large kind of slowdown in SLJ in relationship to silver. SILV is breaking to the upside. It's a breakout and backtest. And SILJ, the silver miners, are lagging. So one could look at the silver junior companies and say, you know what? I'm going to allocate some money to this sector, even though it looks like garbage and the sentiment is really bad. That is taking a contrarian approach. We've got a potential false breakout in the mix of SILJ versus SLV. We're also seeing strength in silver, the underlying physical commodity. We're seeing the TSI or RSI coming on up. So we could see SILJ at some point in the near future really start to take off, and it could be a very good contrarian play here. In your opinion, is it ever good to have debt? Yes, it is. If you take the debt and you buy an asset with it, and it's not a gigantic leveraged play where you're basically on the brink of bankruptcy, there is some good debt. Good debt is buying a house, locking in your costs during a very low inflationary period. And if inflation comes, you can eat that debt away and lock in your costs. That's very good debt. That's the debt that I have. You could also have debt that is good, where you buy an asset, the asset cash flows greater than the payments on the debt, and you get very big positive cash flows. That could also be very good debt. I don't think someone should go massively into debt and be super leveraged. I think there are healthy areas where you can go, 10 or 20% or something of a debt to equity type ratio or something like that. For over 50 years, while a single family home denominated in fiat has gone from bottom left to top right on the chart, it has remained in a sideways channel priced in gold. What you're going to see is you're going to see the fiat push these things higher, and you're going to see gold or all of these different kind of assets priced against each other just go sideways in a valuation channel. Again, you need to understand, how do you value assets? The fiat currency pushes everything higher. You cannot use that. You got to price an asset versus an asset. You buy it when it's cheap. So if this is the amount of gold required to purchase a single family home, what you would do, and I don't know what, so this is the housing to gold ratio. You want to buy homes in 1980, ride it higher, sell it, buy gold in the early 2000s, ride it on down. And you can switch back and forth your assets. You can be overweight gold and platinum and silver when it's cheap. You can be overweight housing or real estate when it's cheap. And then all you do is just go back and forth between the assets. You can use all sorts of assets. Oil, nat gas, platinum, copper, doesn't really matter. S&P 500, which is stocks. And you just switch back and forth. Here's Grady. This is one very long-term, very valid, very bullish, absolutely massive pattern. One of the cleanest, very large falling wedges I've ever seen. And the false breakout move is already done right here. It says it does look ready. And this is Coeur Mining. It's a large silver gold producer in a 27-year bullish falling wedge. I think what's going to happen is energy is going to run first, and then it's going to run hard. I think people, institutional investors, retail investors, everybody's going to start to run at it. And then I think people are going to start to worry about the currency. Gold, silver are going to run shortly thereafter. That could push the mining companies way higher, like it did in the 1970s. YCA, uranium looks good, breaking to the upside. Yellow cake, yeah, it looks fine, fantastic, Scott. Thanks for posting. Looks really good. Here's Cuppy. It says, from now on, everyone betting against bonds is racist, which a lot of people are selling bonds. Tweeting that bonds have AIDS doesn't help anyone. I like it. Thomas said this, and this was 22 hours ago. This was from the Australian markets. He says, the bottom is in, uranium moving on higher. Again, guys, uranium looking fantastic. We've got Dave Ramsey did the largest study on millionaires ever done. He interviewed more than 10,000 millionaires. I read his book, so don't have to. Here's what you should know about it. So the top 5 jobs of millionaires interviewed. Engineer, number 1. Accountant, teacher, management, attorney. 33% of them never had a 6-figure household income. An engineer, you know why we get rich? Because our entire training is about efficiency, and we save, and we're logical, and it's like, I don't want to spend if I don't have to. It's a personality trait, in my opinion, that engineers have, and we're very mathematical driven, so we understand, I think, the math behind a lot of it. So it's like, oh, if I can get compounding to work, it'll just be a matter of time before it really starts to work. At least that's my opinions behind it. 67% of millionaires had a paid off house. Of those with a paid off house, here are some averages. The average size is 2,600 square feet. Average time owning the home is 17 years. Average years to pay off is 11.2. Of the 67%, the majority did not make minimum payments or keep the loan for 30 years. Well, what I'm going to say is I am different than the majority of millionaires. I am a millionaire by net worth or however you want to claim it. I am keeping my mortgage because the mortgage rate is below the inflation rate. When that occurs, it is beneficial to not pay off the mortgage because you're paying the money off with dollars that are valued less. There could be a psychological gain into paying the home off early, but when they do this analysis, when he did this analysis, Dave Ramsey and his team, they're interviewing older individuals that had very high interest rates. of mortgage payments on their homes. And they wanted to pay that off because what you're doing is you're taking a low inflationary environment, which was declining. So you were in a declining inflationary environment, which is disinflation. And they were paying on their home a very high mortgage rate. So the mortgage rate was higher than the inflation rate. So you want to pay off that mortgage as quickly as possible. That is what I would have done if I was in their situation. I would pay that house off quickly as possible, get that off that debt off the books, so to speak, and then start to invest. That is exactly what these millionaires did. They were smart for doing that, but I think we're in different market conditions today where if that role is reversed, if inflation is 5, 6, 7, 8, 9, 10%, the real rate of inflation, and your mortgage is only 2 or 3%, I don't see the problem of keeping that mortgage around. It's an asset versus a liability. College statistics of millionaires interviewed: 88% have a 4-year degree, 62% graduated from public state schools, 50% had a B average or lower, 40% were involved in college sports cheerleading. Income statistics of the millionaires interviewed: 31% averaged 100K household income, 7% averaged 200K household income. So a lot of them were under 100K. Only 7% averaged 200K. Only 3% received an inheritance of 1 million or more. Only 3%, that's pretty low. 94% lived on less than they made, and general population where only 55% say they live on less than they make. Belief matters. 97% of the millionaires said they believe they control their own destiny, compared to 69% of the general public who believe they control theirs. Whether you believe you can or believe you can't, you're right. I'll leave you with this final stat. 75% of millionaires interviewed said that regular, consistent investing over time was the reason for their success. Consistency is key. Happy investing, X. Keep going. And that's the mindset you need to adopt. Consistent, keep building, keep going, break through it, and you own or control your own destiny. I completely agree with that. I don't think it happens by happenstance. And that's where I'm going to end it, guys. So that's what we've got for today. Give me a thumb up for the content, subscribe to the channel, and hopefully everyone, if you're wanting to become a multimillionaire or millionaire, or maybe your first 100,000, whatever it is, keep going, guys. Keep going. Just keep it in the background running, stacking away, stacking ounces, putting money in the account, whatever you do that works for you, you do that. What works for you and has worked for you. But I fully support it, and hopefully you guys continue to keep stacking away whatever you're doing, and we'll catch you next time. This is Finding Value.